If great powers end, they rarely end with a battlefield trumpet. They end with a receipt, a coin that buys a little less, a promise that rolls over one more time, a budget that cannot quite balance. Empires may rise behind flags, but they fade behind price tags. Across history, the same storyline appears again and again. The money gets easier. The bill gets heavier. Confidence thins. Then everything that depended on that confidence starts to shake. Historians point to armies and invasions, and those matter, but the quiet damage often starts in the currency itself. Look at Rome. For centuries, the denarius was not just a coin. It was a contract, a small circle of silver that said the state kept its word. Roads were paved, legions were paid, trade flowed because people trusted that metal. Then the cost of running an empire rose faster than the state could collect. Frontier garrisons multiplied. Administration thickened. Big projects needed funding. Mint masters were told to stretch the silver. First a trim, then another denarius that once meant silver began to mean mostly base metal with a silver wash. Prices climbed because the coins bought less. Farmers hesitated to trade grain for what felt like tokens. Soldiers wanted pay in something sturdier. The machinery of taxes and supply clogged. Rome still had walls and swords, but its money no longer anchored the system. The fall did not happen in a single avalanche. It looked like 1,000 small slides, each one tied to a currency that no longer held its weight. Now shift to Spain in the age of galleons. It may sound like the opposite story. Instead of thinning coins, Spain had more silver than any kingdom had ever seen, mountains of it, mined in the New World and shipped across the Atlantic. For a while, the influx worked like a cheat code. Armies were financed, palaces rose. The Spanish dollar became a standard coin from European ports to Asian markets. But money supply without matching production can be a trap. Prices rose across Europe as more silver chased the same goods. Spain imported finished products it did not make at home and paid for them with metal pulled from abroad. Debt piled up anyway because wars multiplied, and the crown kept reaching for the easiest lever. Borrow a little more. Pledge tomorrow's silver for today's campaign. When creditors lost patience, defaults followed. Then came attempts to tinker with the coinage. Copper stood in for silver. Trust eroded. The wealth that seemed infinite became a conveyor belt: treasure in, payments out, credibility down. Consider Britain at its zenith. The pound sat at the center of world trade. City financiers raised capital for railroads and telegraphs. The currency was tied to gold for a long stretch, and that link signaled discipline. Then global wars arrived. To fight them, the government borrowed on an unprecedented scale and suspended gold convertibility. After the First War, policymakers tried to rewind the tape and return to the old parity. The economy buckled. Exports suffered. Unemployment climbed. The gold link snapped again. After the Second War, debt levels towered over the economy. The empire that administered a quarter of the planet was now selling assets and rationing. The pound lost stature through a series of devaluations. Each one bought time and cost reputation. The empire did not vanish overnight. It shrank in stages as the currency lost its role. Those three stories are not identical, but they rhyme. Costs outrun revenues. Leaders borrow and then reach for the currency to close the gap. Prices move. Confidence slips. The financial core weakens. Power follows the money. That brings us to the present. The United States issues the currency that much of the world still holds. The dollar is the orbit many other currencies circle. For decades, that status delivered real advantages. It may still do so. But even reserve currencies are not immune to arithmetic. Debt grows, entitlements expand, security commitments span the globe. When taxes and borrowing cannot fully cover it, central banks create liquidity. In crises, that can stabilize a system. If it becomes a habit, it can weaken it. From the financial crisis to the pandemic era and beyond, the money supply expanded sharply. Inflation later jumped. It cooled from the peak, but many households still feel prices that are higher than just a few years ago. That is how debasement tends to appear in modern systems. Not as a single dramatic event, but as a slow dilution that shows up in rent, groceries, and interest payments. Reserve status can hold even as debt rises. It can also slip. Some central banks now diversify more widely. Some nations experiment with settling trade in local currencies. Gold purchases by official sectors have increased in recent years. None of that guarantees a swift end to dollar leadership. It does suggest that the rest of the world is building optionality. The British pound's story after 1945 shows how reserve transitions can be long, uneven, and painful for the incumbent. There is also the cost of reach. Empires with expansive commitments historically spend more than their base can comfortably support. Rome maintained distant frontiers, Spain fought on many seas and in many lands. Britain garrisoned and administered across continents. The United States carries alliances, forward deployments, and security guarantees that may be larger than any prior power. Many argue those commitments are necessary for stability. Others warn that the bills compound. Both views can be partially true. The risk is not one decision, it is the accumulation. If you want a simple model for how these narratives progress, think of 7 beats that tend to appear in sequence. First comes dominance. Confidence is high. The currency is trusted, sometimes backed by something tangible, sometimes by a long record of discipline. Then expansion obligations multiply faster than revenues. Then a fiscal gap. Borrowing becomes structural rather than cyclical. Then monetary easing to bridge the gap, whether by thinning a coin, importing treasure, breaking a gold link, or expanding a balance sheet. Then the price level shifts. Then confidence wobbles. Finally, the political and military superstructure that depends on the money has to shrink or reset. Where are we now? Reasonable analysts can disagree. Some would place the United States between the price shift and the confidence wobble, with outcomes still wide. Others would argue the system has built-in strengths that extend the runway for years. What remains constant is the math. Debts that outgrow the economy require some combination of higher growth, higher taxes, lower spending, higher inflation, or explicit restructuring. The list is short because the options are finite. History also suggests 3 broad outcomes once a system reaches this kind of strain. The first is a managed descent. Britain offers a version of this. The currency lost pride of place. Living standards grew more slowly. Influence contracted, but institutions endured, and life did not stop. The second is a hard break. Rome is the example. Money failed as a coordinating tool. The political center fractured. Recovery took generations. The third is a reset. New rules are written. A new anchor, whether gold, a currency basket, or a digital standard, replaces the old. The transition is rough, but the system continues under different terms. If you live in this system, rather than only study it, you do not get to pick the macro outcome. You can control your micro decisions. That is the bloated bank finance lens control, the parts of the bill you actually pay. If inflation stays choppy, floating rate liabilities bite. If you must borrow, stress test your budget at higher rates than today. If your income is variable, build a cash buffer that covers not just rent, but insurance deductibles and property taxes. If your employer's stock is a large slice of your net worth, set rules for how you diversify so that a market dip does not become a career and balance sheet double hit. If you own or are considering a home in a flood-prone or storm-prone area, ask your insurer to quote renewals in writing several months ahead. Compare multiple carriers. Ask your agent to show you how the premium could adjust under new risk maps and how a cap on annual increases compounds. That is the kind of fine print that can turn a comfortable payment into a squeeze. Do not let a low teaser rate blind you to the full carrying cost mortgage, taxes, homeowners, flood, association dues, special assessments. Price all 5 before you sign. If you invest, look through the yield. Mild inflation penalizes fixed cash flows most. Ask what a bond or rental looks like after insurance jumps and maintenance normalizes. If you rely on short-term rental income, model lower occupancy and higher compliance costs. Assume that what was easy money in the boom years may be tougher money in the reset years. If you keep significant cash, diversify your parking spots within insured limits. Review counterparty exposure for brokerage sweep accounts. Understand the difference between bank deposits, money market funds, and treasury bills. Convenience fees and idle balances are the micro versions of bloat kill the bloat. Keep your money. Back to the macro track. A common objection to caution is that the United States has unique strengths, a huge internal market, deep capital pools, a culture that produces new firms and new ideas. All of that may be true, and it matters. It might be enough to sustain leadership even as debt rises, but strengths do not repeal arithmetic. They buy time. Wise systems use that time. That points to a final principle the historical cases whisper to anyone who listens. Credibility is policy. When Rome clipped coins, it traded short-term relief for long-term distrust. When Spain lived on imported treasure, it skipped the hard work of building a productive base and paid the price later. When Britain tried to bolt back to an overvalued gold parity, it chose prestige over practicality and made the adjustment harder. Credibility is not a speech. It is a budget and a balance sheet. If policymakers wanted to extend the life of the current system, they could show a believable path where nominal GDP grows faster than debt for many years in a row, that may require stricter spending choices, more targeted borrowing, pro-growth reforms, or some inflation that is contained rather than runaway. If they do not choose, markets may eventually choose for them. The market's method is blunt. Yields move, currencies adjust, credit limits appear. You do not need to predict the exact timing to protect yourself. Track a short list of real-world signals. Is inflation surprising to the upside for multiple quarters? Are long rates rising faster than short rates even as growth cools? Are more countries invoicing trade outside the dollar? And are central banks lightening their dollar reserve share at the margin? Is the policy response credible or reactive? Those 4 questions, watched over time, tell you more than daily headlines. The lesson across 2 millennia is not that collapse is guaranteed. It is that decline is a choice stretched over many choices. Systems that respect their money can adjust. Systems that use their money as a shortcut eventually run out of shortcuts. You do not need to panic to prepare. Turn down leverage where you can, price in the full cost of ownership. Keep liquidity that is truly liquid. Demand clarity from your counterparties. The game may continue for longer than pessimists expect. When it changes, it usually changes faster than optimists think. Here is a way to hold the whole story in one picture. Imagine a vault door marked trust. In good times, the door seems permanent. In strained times, leaders drill small holes in the hinges to get through today. A little more coinage here, a little more credit there. The door still stands, so the next group drills again. One morning the hinge fails. The vault does not slam. It sags. What spills out is not just money. It is the capacity to coordinate. Taxes become harder to collect. Projects become harder to finish. Promises become harder to keep. That is what history calls collapse. If this felt like bad news, consider the alternative view that sits right beside it. Systems break because people shrug. Systems bend because people pay attention. If households, firms, and voters reward credibility, leaders adopt it. If we do the opposite, we get more of what we tolerate. The script is not finished. It rarely is. You may never run a mint or draft a treaty. You do run a household balance sheet. Price everything you can control. Pressure test the rest. Keep the habits that survive booms and busts. Spend less than you earn. Keep a cushion. Beware fees and fine print that compound against you. Diversify sensibly. Avoid leverage that needs perfect weather. These are boring lines. They are also the lines that keep you steady when big systems wobble. Empires do not end because the stars decide it. They end because of a pattern of choices. Spend beyond means. Borrow to cover the gap. Debase to cover the borrowing. Watch prices move. Watch confidence erode. Then face a reset that might have been less painful if honesty arrived sooner. If you see that cycle repeating in our time, you are not alone. If you think it can be slowed or reshaped by better choices, history leaves room for that too. The point of studying these patterns is not to cheer for failure. It is to recognize the warning lights early and prepare at the scale that matters to you. When the money gets easier, look harder at what it buys. When leaders promise painless fixes, ask who pays and when. When headlines say this time is different, check the math. If this helped you see the moving parts, subscribe. Here we keep the focus on the bill you actually pay and the levers you still control. Cut the bloat, keep your money.